Thank you for having me. Today I'm going to speak whether competition is a cure for confusion, looking at some evidence from the residential mortgage market. This is joint work with Stephen Malaris and Daniel Rettel, who are colleagues of mine at University of Georgia. Competition among sellers and financial sophistication among buyers are two things that are generally considered to influence transaction prices. To the extent that these two forces operate simultaneously, it has become customary to think that the relationship between the two is substitutive. In other words, what we mean is the cost of unsophistication tends to be lower when competition is vigorous. For example, in the financial markets, this is what we see. Competition gives us efficient market, and that reduces the cost of unsophistication. In this paper, we will use a national mortgage data set to examine the substitutability between competition and sophistication. What we find is competition does not substitute for sophistication in the residential mortgage market. Competition is indeed a good thing. It benefits both unsophisticated and sophisticated borrowers. But even after controlling for risk factors, the gap between unsophisticated and sophisticated borrowers does not reduce in the presence of competition. What I'll do in this presentation is show you evidence that led me to this conclusion. I'll do it in three pieces. The first part is quantifying the effect of unsophistication. I will do it in terms of how much more does an unsophisticated borrower pay for a mortgage interest rate as compared to a sophisticated borrower, controlling for risk factors. Once we've established, so this will form our baseline estimates for cost of unsophistication. We can also think about it as cost of being unfamiliar with the mortgage process. Once we've established the cost of unsophistication, we'll move on to analyze what are the possible ways to reduce this cost of unsophistication. So what we find in the first piece is sophisticates get a better deal. Ones who know what is going on in the market get a better deal than the ones who don't know what's going on in the market. This is, or one of the reasons why this could be a relevant question is we find that financially sophisticated borrowers are also individuals who are wealthier and well-educated. So if the financially unsophisticated individuals are also the ones paying higher cost because they are unsophisticated, the cost is higher for individuals or borrowers who have the least resources to make those expenses. So it would be nice to understand what are possible ways to reduce this cost of unsophistication. One potential force could be education, but it has been shown that it has limited effectiveness. The other source could be advice. Even that has shown to have limited effectiveness. In the paper, we talk a little bit about education and advice, but for the purposes of this presentation, I'll focus on the last piece, which is competition. So when we started the project, we thought competition might play a role in reducing the cost of unsophistication, as it does in the efficient markets. In the efficient markets, anybody can go and buy and sell at the market price without knowing much about what's going on with the firm. So to do that, what we will do is move on to quantifying the effect of exposure to competition. We do this in terms of how interest rates differ between individuals who shop multiple lenders versus those who shop with just a single lender. Having established the baseline estimates for unsophistication and competition, I'll move on to analyzing whether competition and sophistications are substitutes. And in other words, analyzing whether the rate gap between sophisticates and unsophisticates narrow in the presence of competition. To answer these questions, we have to measure financial sophistication and competition. We do this using the National Survey of Mortgage database. This is a database which has recently been made publicly available. It has a lot of interesting questions, so I encourage all of you to have a look at it. We are measuring financials. The core of this survey, and I'll get into the details of the survey, but the core of the database is coming from a survey which is administered by Federal Housing Finance Administration and Consumer Finance Protection Bureau to recent home buyers. We measure financial sophistication by looking at self-reported understanding of the mortgage process. And what we find is unsophisticated individuals pay 7 to 10 basis point higher rate spread as compared to a sophisticated individual controlling for the risk factors. This amounts to an additional upfront expense of around $2,000 over a 30-year period for an average mortgage in our data set. We're measuring competition as the number of lenders seriously considered. So a borrower, when he considers more than one lender, he's considered exposed to competition. If you just go to a single lender, you're not considered exposed to competition in our model. Borrowers who consider multiple lenders pay 7 basis points less as compared to a borrower who just considered a single lender. And as I mentioned earlier, competition does not help in reducing the rate gap between the sophisticated and unsophisticated individuals. Competition is a good thing, but it benefits both the sophisticated and the unsophisticated individual. I'll not get into the details of the literature review, but our paper broadly contributes to two sets of literature. The first is financial literacy leads to better mortgage outcomes. The second literature is shopping for mortgage reduces cost of borrowing. The paper closest to ours is Bhutta et al. It's a recent working paper. They also have an amazing data set where they observe the entire underwriting file from a particular lender. Given that information, what they can document is there is huge variability in interest rate paid by borrowers that cannot be explained by the underwriting information. In other words, two borrowers who are taking out the same mortgage product with very similar underwriting files are paying different interest rate. And this is important to document because if we expect financial sophistication to affect rate spreads, this is what we would expect to see. Two individuals taking out a similar mortgage product, having similar underwriting files, one being unsophisticated, the other being sophisticated, and ending up paying different interest rates. They also look at how mortgage rates decline with financial literacy, mortgage knowledge, and shopping. While we are using self-based assessment of financial sophistication, they are using measures following Lusardi and Mitchell from the Survey of Consumer Finances. We should think about our paper as focusing on the role of sophistication, competition, and the interaction. And their paper focuses on the broader context which shows us that there is a dispersion in the mortgage rate to begin with, and that is important. And the key distinguishing feature apart from the literacy measure is the interaction that I talked about. So we're using this data, which is the National Survey of Mortgage Originations. It's a survey, it's a nationwide survey, and the borrowers are asked about their loan shopping behavior, their expectations about the property market, their shopping behavior, their understanding of the mortgage process, etc. Just to give you an idea of what the questionnaire looks like. So this is just the first few questions from the survey. The first one is, did you in the last couple of years take out or co-sign a mortgage, refinance, modify, yes, no? If you did, when did you do it? Did you sign it or co-sign this mortgage, and so on. Apart from this rich information that is coming from the survey, the cool thing about this data set is it's matched to administrative loan level data. So because of this matching, we are able to get a lot of details about the mortgage and borrow. We know, so starting with the mortgage characteristics, we know the loan amount, loan to value, debt to income, payment to income. We have information on borrower characteristics, gender, age, race, income, education, risk tolerance, risk preference, etc. We also observe the credit scores. They do a good job of tracking the loan after it has been originated. So we have information on whether the payments are current, whether there has been a default. Future credit scores, as I mentioned, it covers January 2013 to December 2016. There are around 24,800 completed surveys. We restrict our analysis to conventional non-jumbo fixed rate mortgages, and therefore we have 16,800, a sample of around 16,800. To give you a quick snapshot of what the data looks like, our key dependent variable is going to be rate spread. Rate spread is defined as the difference between interest rate and primary mortgage market survey rate. Primary mortgage market survey rate is a survey done by, it's a weekly survey done by Freddie Mac, where they ask the lenders to report the rate at which they are offering to the consumers. So the average rate spread is 0.36. The other important thing that I would want to mention is in the publicly available file, the rate spread is winsorized at minus 1.5 and plus 1.5. However, this is not a concern for our analysis and the conclusions that we make, because we sent our code to FHFA and they again ran it on the entire unwinsorized data set, and we get similar results. In fact, the results are better, as you would expect, on the entire unwinsorized data set. The primary mortgage market survey, the average is 3.65 for our sample, average loan to value of 70, credit score of 757. We have some gender and race characteristics, age, retirement status, marital status, and a lot more borrower characteristics that we control for in our specifications. There are a lot of interesting questions in the survey, but one that I find fascinating is this question: how satisfied are you that the mortgage you got was the one with the lowest interest rate for which you could qualify? And 72% of the individuals say that they are very satisfied, though the median rate spread for a sample is 26 basis points. Now let's look at how we measure unsophistication. We measure unsophistication on the basis of question 5, which asks, when you began the process of getting this mortgage, how familiar were you and your co-signers with the mortgage process? With each of the following. And there are 7 sub-questions: mortgage interest rate, different types of mortgages available, process, down payment needed to qualify for a mortgage, income needed to qualify, credit history or credit score, money needed at closing. The respondents answer on a scale of very, somewhat, not at all. An individual is classified as sophisticated if they respond very to any one of the 7 questions. So conversely, an individual is classified as unsophisticated if he did not respond very to any one of the 7 sub-questions. To define it more formally, again, it's the same slide written out here. Ex ante unsophistication will take a value of 1 if they do not report very familiar for any of the 7 sub-questions. Similarly, there's another question, 56, which asks, how well could you explain to someone the process of taking out a mortgage, difference between fixed and adjustable, prime and subprime, interest rate and APR, amortization of loan, consequence of not making a mortgage payment. Ex post unsophistication takes a value of 1 if they do not report very familiar for any of the 6 sub-questions. So one of the advantages of using these questions are it's directly related to the mortgage related knowledge. So what has been done in the prior literature is they've looked at domain general knowledge like education. In this case, we're looking at a very domain specific financial question. Moving on to our first set of identification strategies to analyze the effect of sophistication on rate spreads. Now, it would be really nice if we could randomize individuals as being financially sophisticated or unsophisticated. Of course, we cannot do that. So what we do in this case is include a lot of fixed effects and borrower characteristics, basically all the observable borrower and mortgage characteristics, And we think we are able to do a pretty good job given the richness of the data set. So as I mentioned, the dependent variable is rate spread. We include borrower characteristics like gender, age, race, income, education levels, risk preference, etc. We're including 4 fixed effects: origination year-month fixed effect, loan term fixed effect, 2-digit credit score fixed effect, loan-to-value fixed effect. So what we are doing is comparing between borrowers with a similar credit score, similar loan-to-value ratio, who've taken out the mortgage in the same month for a similar loan term. And standard errors are clustered at the origination month-year level. As I mentioned, in the publicly available file, rate spread is Winsorized at -1.5 and +1.5. So we are going to use a Tobit model for all our regressions. What we find is an individual who is ex-ante unsophisticated pays 7.3 basis point higher rate spread as compared to someone who's sophisticated. If we look at ex-post unsophistication, an individual who is ex-post unsophisticated pays 10.4 basis point higher rate spread as compared to an individual who is sophisticated. 10.4 is approximately 1.8 to 2.6. So these 1.8 to 2.6% of the average borrowing cost. So this leads to somewhere around 1.8 to 2.6% increase in the borrowing cost. Next, we wanted to analyze whether one of these measure dominates the other. So we include both of them in the same specification, and what we find is ex-post unsophistication, the coefficient is slightly higher than ex-ante unsophistication, which tells us that information learned during the process is also important. It is not only the endowed information, but if you accumulate information during the process, it benefits you. Next, we include both of those and an interaction term. And what we are trying to analyze here is an individual who continues to remain unsophisticated during the process. Is he paying much higher rate spread as compared to an individual who's just ex-post unsophisticated? And we find that is not the case. The interaction term is negative, and it kind of almost exactly cancels off ex-ante unsophistication. So, of course, we can say that these are self-reported measures and there might be noise in how we are measuring unsophistication, but all this noise is of the second order because, as you see here, individuals who report that they are unsophisticated are also the ones who are paying higher rate spreads. To focus a little bit more on the role of learning, in the questions that we've used earlier, we are using the entire array of questions. To get a cleaner measure of role of learning, we focus on one particular question which is repeated in the 5th and the 56th question, which is, when you began the process of getting this mortgage, how familiar were you with the mortgage process? How well could you explain to someone the process of taking out a mortgage? Based on how participants' knowledge has evolved, we assign them into 4 categories: never familiar, not familiar to familiar, familiar to not familiar, and always familiar. Here the omitted category is always familiar. So we find that individuals who are never familiar pay 8.8 basis point higher rate spread as compared to people who are always familiar. If you move from being familiar to not familiar, you pay 7 basis point higher rate spread as compared to if you're always familiar. There is no statistical difference between not familiar to familiar and always familiar category. We split the sample on the basis of advice and credit score, we get similar results. So the 2 confounding questions could be whether the influence of unsophistication on rates simply reflects an increase in the risk factor associated with the unsophistication, which the lender is able to observe but is unobservable to us. 2 key risk factors would be probability of default, probability of prepayment. We have future credit scores, we control for it, and we don't see, and therefore we can rule out these 2 confounding factors. We measure exposure to competition using this question: how many different lenders, mortgage brokers, did you seriously consider before choosing where to apply for this mortgage? To motivate this measure, let me take you through a thought experiment. In this thought experiment, to measure the effect of competition, we randomly assign borrowers into one of two groups. Group 1, each borrower is matched to a single lender. The lender gives them a take it or leave it offer. Group 2, thanks, that helps. Each borrower is matched to two lenders. The two lenders compete for business as the borrower accepts at most one offer. So in this scenario where borrowers are randomly allocated to one of the two groups, they are of similar credit risk. And what we could do to measure the effect of competition is just look at the rates between the difference in rates paid between group 2 and group 1. However, the real world, which we can measure using question 11, departs from our thought experiment. And it can depart in broadly three ways. The first case could be for completely exogenous reasons. I stay close to one bank and therefore I just decide to shop with one bank. Richard, you stay close to two banks and therefore you shop with two banks. And in this case, we are back to the exogenous world and our world of thought experiment. The other reason could be due to observable borrower characteristics like education. To the extent that we can measure it, we'll be able to control for their effects, and therefore it's not a problem for our analysis. The third group could be unobservable borrower characteristics, and these unobservable borrower characteristics will also affect the interest rate at which the borrowers and lenders transact. Now, this third category or characteristics in this third group could be positively or negatively related with rate spreads. But to the extent that going to multiple lenders is considered a thing which financial savvy individuals are more likely to do, we would expect it to be positively correlated with interest rate. And therefore, going back to what I was telling you earlier, we should think about our results as an upper bound of the true effect. So the identification strategy here to analyze the effect of competition on rate spread is similar. Competition takes a value of 1 if you're exposed to more than one lender. It is 0 otherwise. So the only difference is addition of this term, competition. What we find is individuals who go to multiple lenders pay 6.3 basis point lower rate spread as if they went to just a single lender. The coefficient on ex ante and ex post unsophistication is similar as compared to our baseline model. Now, I had told you that we should think about these results as being an upper bound of the true effect. But there is one force in the opposite direction, which could be that some individuals who are less creditworthy are shopping around. And that could be because they are being turned down continuously by lenders. So our survey allows us to look at it. There is a particular question which asks, why did you shop around? Did you shop because you were concerned that you would be turned down or to seek lower rates? So we modify our competition measure to take a value of 1 if you considered more than one lender to seek lower rates. And what we find is it reduces rate spreads by around 6.8%. Just as a validity check, we look at if you considered more than one lender because you were concerned that you would be turned down or you were actually turned down, it has no effect on rate spreads. Our secondary measure of competition, and this is going back to your question about controlling for background competition, we have information on whether the borrower is in a middle or high income tract in a metropolitan area. Once we use that as a measure of competition, we find that interest rates are lower by 3.8 basis point for these borrowers. We augment our competition measure, and this is our preferred specification. The borrower is in a metropolitan area, considers more than one lender to seek lower rates. And in this scenario, competition helps. It reduces rate spread by around 7 basis points. The coefficient on ex ante and ex post unsophistication are similar to what I had shown you in the baseline model. For our data, the correlation between unsophistication and competition is not very high. That doesn't mean that they are not correlated in real world, but It just doesn't seem to be very high for our data set. So moving on to the last piece, which is the substitutability between competition and sophistication. So we are augmenting our base identification strategy by including an additional interaction term, competition multiplied by unsophistication. In this particular model, unsophistication takes a value of 1 if you're ex ante or ex post unsophisticated. So the beta coefficient, we would expect it to be positive. If you're unsophisticated, you're paying higher interest rate, beta is positive. Beta is positive, yeah. Competition is a good thing. It is reducing rate spreads, and therefore gamma is negative. If we expect, or that was our prior at least, if we expect competition to be a substitute for unsophistication, we would expect delta to be negative. So the rate gap in the presence of competition will reduce, and therefore we were expecting the interaction term delta to be negative. This will not be much of a surprise because I have been telling you all this all along. We don't find it to be negative. In fact, it is positive. So unsophistication, similar result. If you're unsophisticated, you're paying higher interest rate. Competition is good. It reduces rate spread by around 7 basis points. It does not help in reducing the rate gap between unsophisticated and sophisticated individuals. It benefits both these individuals. As a robustness, we look at the other measure, which is in the metropolitan area, considering more than one lender to seek lower rates, we get similar results. So though our results are, at least were surprising to us and contradicted our intuition, there is some theory which might explain the results that we find. So why competition and sophistication might not be substitutes? We're drawing from two broad theories which don't directly speak to the mortgage market, but are kind of giving us the basic background to think about it. The first could be competition drives lender to add more favorable menu options, but not necessarily remove tempting but costly options which are chosen by unsophisticates. There's some evidence, Woodward and Hall in their AER paper show that when competition increases, the number of mortgage products increases, and that is something that might be going on. A related story could be lenders have a noisy technology for identifying the sophistication of potential customer. So we go to a bank or a lender, they get a typed signal. If they get a signal that we are unsophisticated, they're probably charging us slightly higher than what they would charge if they got a typed signal that we are sophisticated. And there's some work in discrimination literature which shows that an equilibrium can be maintained where banks are able to charge some category of individuals a slightly higher rate, and they can maintain that equilibrium in the long run. So to conclude, unsophisticated individuals pay 7 to 10 basis point higher spread as compared to sophisticates. These rates do not seem to be picking up increased risk for the borrowers. Financially sophisticated borrowers benefit as much from competition as unsophisticated individuals. Therefore, the rate gap between sophisticated and unsophisticated individuals does not reduce in the presence of competition. I've shown you some evidence of this. Borrowers who learned during the process pay similar spreads to borrowers who report always being familiar. We've done a lot of work on advice, but the evidence there seems to be mixed, so I'll not get into details of that in this presentation. This complements the work which detail the limit of advice and education. Collectively, it's painting a pessimistic view about the prospects of closing the mortgage rate gap. Once I was presenting it and someone in the audience said, do we want to close this rate gap? That's a different question which we are not answering, but yeah, competition is not helping us reduce this gap. Thank you.
All right, thank you, Jorge, for asking me to discuss this paper. Thank you, Ruchi, for a very good presentation. I really enjoy reading this paper. I mean, that's why maybe I have 32 slides in my discussion compared to what you have, because I like it even more than you more than you did. Now, honestly, it's always, very, very good when you read a paper, you ask yourself questions, and you see those questions answered as you go through the paper. I mean, and this paper does a lot, and I think it would have probably taken Ruchi, a couple of hours to present everything they have done in the paper. It's very, very comprehensive. Okay. What is this paper about? This paper is about whether really information acquisition or sophistication can really substitute for competition, okay? Because in a world where the mortgage markets are really competitive, then there is no role for sophistication. But as you find there is a role for sophistication, maybe that's an indirect test that the market is not as competitive as it should be, right? Maybe, okay? So what does it show? It shows that sophistication, basically sophisticated lenders or sophisticated borrowers or unsophisticated borrowers basically pay a cost, okay? They pay a cost. They can definitely, reduce their borrowing costs by acquiring information about the mortgage. That competition also has a negative effect on spread, as you would expect, okay? The mortgage market may not be that competitive, but it's still quite competitive because when competition is higher, interest rates are a bit lower, okay? But competition doesn't really substitute for information acquisition, okay? And information acquisition. The gap is still there. But unfortunately, I mean, this is when we're expecting, okay, does it help to, what's the best way really to acquire information in order to really reduce your, this gap? But except maybe for hiring an agent, okay? You don't really see most of the channels don't really work. I mean, I was even surprised to find that going to the web and doing a web search doesn't really even lead to a higher gap than really a lower gap when I looked into it. So I was wondering, why is that? Why is that? What may cause that? Is this some way related to fintech borrowers, for instance, fintech lenders, because fintech lenders tend to be a little bit more, more expensive. Anyway, I mean, this is a very important research question, okay? And I just have a quick, some comments. Most of those comments have really been already asked, to be honest. They focus more on the two aspects of this research. First, sophistication, okay? She uses two main measures. They use two main measures of sophistication, an ex-ante measure and an ex-post measure, and of course they show very strong correlation, okay? Very strong correlation, a negative correlation with interest rate, okay? The question is now, what we are interested in is really causality, right? And I think there is no doubt that the ex-ante, the way it's defined, you can definitely, I think it's very difficult to argue against causality there. The ex-post, I'm not sure, okay? And I think the ex-post, the correlation is there, no doubt about it. But now the question is, how do people who report ex-post that they have learned about the mortgage process, that basically learning did affect how they were able to negotiate their mortgage rate, okay? It may be that information is not really, it's post even the mortgage negotiation. I was even thinking about myself because sometimes, you have to be quite sophisticated in this market really to even understand sometimes what's happening. You're talking about educated. I took a mortgage, I went home, I told myself, you know what, I have learned a lot about the process, but I made a mistake, okay? Recognizing that I made a mistake and reporting that I have made that mistake, that doesn't mean that mistake did help me in any way get a better mortgage, okay? That's just something to think about, okay? And that's this point. But also I think, as I was going through table 5, okay, you did a good job when you were looking at familiar and unfamiliar, putting all the borrowers into different buckets, okay? I think it would be good also. I was kind of looking for something similar for the ex-ante ex-post. I think that would allow me to understand exactly what's the control group, because every time I was looking at the different estimations with the different, indicators, I was always wondering, what's the omitted group here? Okay, in order to get a better understanding of really this effect I'm seeing. I think that would help. And I was also thinking that it would be very good to basically map this on education and income, okay, in order to get a better understanding who are these people really, okay. Another thing I think this survey data is so good. And what you do in the paper is just use this indicator if you report very knowledgeable about one dimension and basically say, okay, sophisticated. I don't think all these questions are really the same. I think knowing about, for instance, the difference between fixed and adjustable is probably more valuable than just knowing about the process. Okay, maybe you can dig into the richness of this survey in order to even, I think, provide some more explanation here. And I was even thinking you can use a ranking system, or you can even, if you want, develop some kind of index. But I think it would be just a little bit, maybe, something to think about. Okay, and I was also, you could. The nice thing about an index, even though sometimes you don't know exactly, what the elasticity of gaining knowledge, you don't really know what it means that much, but I think it could be quite useful. Okay. My next comment is really about the competition measure, and Ruhan, some people have already talked about it, because when I think about competition, usually I'm not thinking about the search cost. Okay, and I think your metro measure kind of takes care of that a little bit. But I was thinking also about, why, can you think about, maybe I'm going a little bit, because there is more data available out there about mortgage origination, the HMDA data. Can you use the HMDA data to compute an independent competition measure that you could basically just use as a robustness check, for example? Okay, but the challenge about the HMDA data, though, is that the public HMDA data, at least it's annual. It might be very difficult for you to have a time series of competition. Yeah, that's kind of what I was thinking, because this is, I have seen a lot of competition, papers. That's what they use in the mortgage market. Okay, thank you. They use the HMDA data to compute some measure of competition. But I was even thinking about the data you have. Can you use, because this is a search that borrowers do, that they report, okay? But that must be conditional to the competition within the marketplace, right? What about computing just an average number of search by location and use that as a competition measure, for instance? Okay. And another thing I was thinking about that I didn't see in the paper is really the fintech industry, okay, and how it has really affected this market. I mean, this is 2013 to 2016. And now, someone like, a company like Quicken, those guys are the largest, really, mortgage originators. How does it play a role here, okay? But maybe it's already part of this survey. Maybe those people reporting are also going to the net and talking to, people like, to mortgage originators like Quicken. Just, something to think about, okay? Okay. Because honestly, I was even talking to someone. I mean, these days, can we think about the mortgage market as being a local market anymore? I mean, it's a question. Okay. Now, some additional comment here. I heard you have kind of talked about this when I stepped out. This was always in the back of my mind: endogeneity. Okay. And you did say that you did try some IVs, okay? But I don't see anything mentioned in the paper about that. Maybe I missed it, okay? There is no mention. I think that's something you should just mention in the paper if you have done it already to make people feel comfortable, okay? Something I thought about, Richard talk about points, and you made a very strong argument why point really would basically, it's not a big issue for your result. But I was thinking about non-recourse and non-judicial foreclosure states, okay? Because I have a paper, and it has been documented that in these states, borrowers do pay a higher rate. Can that explain part of what you are finding? Something to look into, okay? When you talk about the risk-based explanation here, okay, this is the part where I kind of really kept scratching my head. And this is when you basically use change in credit rating as a proxy for information that lenders may have collected, and maybe to basically explain that the spread that you are documenting is not really due to some unobservable information that these lenders have collected. I understand what you're trying to get, to in this exercise. But honestly, I think oftentimes people's credit rating may change for nothing related to, without them, defaulting on their mortgage or being riskier for the, as far as their mortgage is concerned. And that's just something to think about, okay? Because a lot of people do face, for instance, health issues, or they face, I'm almost done. Do face health issues that really may have affected their credit score. Not anymore, probably, but that's just something I want you kind of to think about, okay? Forget about it. I would have liked to see more in this. I would have liked really to see you do more with sophistication, first-time buyers, sophistication, minorities, interactions. That's just something to think about. That's my wish. So that's it, okay? Just to finish, most of these mortgages were originated between 2013 and 2016. And when I was looking at the descriptive stats, for LTVs, for instance, forget about this. For LTV, for instance, I just show that the LTVs from 2 to 25 was, this extreme was just surprising to me during that period, okay? Oh, boy. When I look at credit scores as well, the minimum credit score was about 450, I think. That was just a little bit surprising to me, okay? Maybe you need to winterize credit score and LTV and see whether your result is still hold, okay? Overall, this is a very important question, a very nice paper, and I really enjoyed it. And I think your research are really convincing because you do so much robustness check here, so many robustness checks. I feel comfortable about the result. Thank you.
Thank you, Moussa.